Okay, let's jump right in. 14th largest supplier globally, 15th biggest importer.
That's Singapore we're talking about.
Exactly. A tiny nation, but a giant in world trade. Seriously, if you're even thinking about global trade, especially looking ahead to 2025, well, Singapore needs to be on your radar.
It really is remarkable, isn't it, how strategically they've positioned themselves. It didn't just happen by accident.
No, definitely not. And that's our focus for this deep dive. The nuts and bolts of setting up an import-export business right there in Singapore. We've got this fantastic guide, really comprehensive
It
stuff.
lays it all out.
So think of this session as your shortcut. We want to help you understand why Singapore is such a powerhouse and what steps you actually need to take to get started there efficiently.
And our mission really is to pull out the absolute must-know information from this guide, cut through the clutter, If you're eyeing international trade, maybe through Singapore, this is the critical info you need.
Precisely. So why Singapore? What makes it tick for trade? First up, and it's almost a cliche, but it's true, location.
Oh, absolutely fundamental.
It sits right at the crossroads of major international shipping routes. We're talking over 30% of Asia's trade passing through. That's, what, $5 trillion in goods moving between East and West every year.
And think about the access that it gives you. It's not just Southeast Asia. It's a springboard to the Middle East, wider Asia, globally, really. That geography is just incredibly advantageous.
But it's not just being there, is it? It's what they've built. Their infrastructure, ports, logistics, air cargo consistently ranks among the best, if not the best, in the world.
Right. You can have the best location, but if getting goods in and out is a nightmare, it doesn't help much. They've invested heavily in making it smooth.
Super efficient, like highways for global trade, as you said.
Yeah, exactly.
Then there's the business side of things. Ease of doing business. Singapore is number 2 globally.
That's a huge draw.
Registering a company, getting licenses, handling cross-border stuff. They've streamlined it incredibly well. Less bureaucracy, faster setup for you.
Yeah, removing those hurdles makes a massive difference, especially in the complex world of international trade.
And, okay, let's talk money. Taxes. This is often a big one.
Always is.
They have a pretty low corporate tax rate, just 17%, no capital gains tax, and crucially, over 70 double taxation avoidance agreements, DTAAs.
And those DTAAs are vital for international businesses. They basically stop you from getting taxed twice on the same income, once in Singapore and again somewhere else.
Which directly boosts your profitability, right?
Yeah.
Makes operating across borders much more viable.
Absolutely. It clarifies who gets to tax what, simplifying things enormously.
Plus, the financial system itself is rock solid. You've got over 500 international financial institutions there.
Which means access to capital, trade finance, all the tools you need are readily available. That financial muscle is essential fuel for trade.
And finally, something maybe less tangible but just as important, trust. Very low corruption, strong rule of law.
One of the least corrupt nations, consistently.
For you, that means transparent processes, knowing contracts will be enforced, reliability.
That predictability is gold in international business. It encourages investment because people feel secure.
Okay, so the case for Singapore is pretty strong. Let's say you're convinced. How do you actually, set up shop?
Right, practicality.
The main government body you'll deal with first is ACRA. That's the Accounting and Corporate Regulatory Authority.
ACRA, they handle all the company registration stuff. That's your first port of call, legally speaking.
And the guide suggests the most popular business structure, the one most people go for, is a private limited company.
Makes sense. It offers scalability, those tax benefits we mentioned, and it just looks more credible often. Plus, it separates your personal liability from the business.
Good point. Okay, specifics. What do you actually need? Minimum paid-up capital, how much cash up front?
Surprisingly little, just $1 Singapore dollar to start.
$1? Seriously?
Yep. You can always inject more capital later as the business grows. It makes starting up quite accessible.
Okay. Shareholders.
Between 1 and 50, and they can be individuals or other companies, quite flexible.
Now, here's a key requirement. You need at least one resident director.
Ah, yes, this is important.
This person has to be a Singaporean citizen, a permanent resident, or hold what's called an entree pass. That's a visa for entrepreneurs.
Right, so you need some local presence in the directorship. It ensures local accountability.
And you also have to appoint a company secretary, based in Singapore, within 6 months of setting up.
They handle the compliance side, making sure you're following all the local rules and regulations.
Naturally, you need a physical registered office address in Singapore, too. Can't be just a P.O. box somewhere else.
Needs to be a local address for official communications.
And before all that, you need to get your company name approved by ACRA. Make sure it's unique and meets their guidelines.
Standard procedure, but essential.
Once you're registered, boom, you get a UAN, unique entity number.
Your company's ID number.
You'll need that for pretty much everything involving the government, especially Singapore customs when you start importing or exporting.
It ties everything together, makes interactions smoother.
Now, a tip from the guide, particularly if you're based overseas, consider working with a local incorporation specialist, like On Demand International, who wrote this guide, for instance.
Yeah, that can be really helpful. They know the local landscape, the potential pitfalls. It can definitely speed things up and ensure you're compliant from day one.
Saves you headaches down the line, probably.
Almost certainly.
Okay, company registered, check. What about the actual goods? What's typically moving in and out of Singapore?
The guide gives some good examples. On the export side, you see a lot of electronics, semiconductors.
High-tech stuff.
Definitely. Also, machinery, transport equipment, pharmaceuticals, and petroleum products. Reflects their strengths in manufacturing and energy.
And imports? What's coming in?
Lots of consumer electronics, cars, packaged food and drinks, clothes, textiles, a real mix.
So catering to both consumers and other industries in the region.
Exactly. It serves its own market, but also acts as a big distribution hub.
Right. Let's get into the nitty-gritty.
Yeah.
Moving the goods. Importing first. What are the key steps?
Okay, number one, you need to declare the goods via TradeNet. That's their electronic system.
And crucially.
You need that import permit before the shipment arrives. Don't wait until it's sitting at the port.
Got it. Paperwork. What documents do you need?
The usual suspects, mostly. Commercial invoice, showing the value. Packing list, detailing the contents.
Bill of lading for sea freight. Airway bill for air.
Yep. And a certificate of origin if you want to claim benefits under a free trade agreement.
Right, for preferential tariffs.
Right.
And then obviously paying any customs duty or GST that applies.
And finally, clearing the goods through customs at the port or airport.
Seems straightforward enough if you're prepared. What about exporting? Similar process.
Pretty similar, yeah. You apply for an OUT permit, again through TradeNet.
And you need to check something specific.
Yes, check if your goods are controlled or strategic. Those might need extra specialized permits depending on what they are and where they're going.
Okay. Documentation.
Commercial invoice again, an export packing list, and certificate of origin if applicable, just like imports.
Then you either handle the shipping yourself or more commonly use a freight forwarder.
Right. And one really important note from the guide, record keeping.
Ah, yes. How long?
Singapore Customs requires you to keep all your trade documents, invoices, permits, everything for 5 years.
5 years. Okay, good to know. Don't shred them early.
Definitely not. Need that paper trail.
Now, something you mentioned earlier, Singapore is a hub. The guide talks about transshipment. What exactly is that?
It's basically bringing goods into Singapore, maybe doing something minor like repackaging or relabeling, and then immediately exporting them out again to a different final destination.
So using Singapore as a stepping stone.
Precisely. Leveraging that location and efficiency. It's a huge part of their trade volume.
And what are the advantages of doing that?
Big one. If the goods stay within a designated free trade zone, or FTZ, while they're in Singapore.
No import GST or duty.
Correct. Big cost saving. Plus, you get access to really flexible warehousing and specialized logistics services designed for this kind of movement.
The guide calls it a strategic link between places like India, the Middle East, and the rest of Asia Pacific.
That sums it up well. It connects these major trading regions very efficiently.
Makes sense. If you're doing import-export, you'll need storage. What are the warehousing options?
The guide breaks it down. You've got public warehouses, kind of pay as you go, good for maybe smaller businesses or those starting out.
Okay.
Then bonded warehouses. These are key if you're dealing with goods that are subject to duty, like alcohol or tobacco.
How do they work?
You can store the dutiable goods there without paying the duty or GST immediately. You only pay when or if the goods are released for sale within Singapore. If you re-export them, you might not pay the Singapore duty at all.
Helps with cash flow then.
Exactly. And then you have the free trade zones we just mentioned, the FTZs. Inside those, goods meant for re-export are generally exempt from duty and GST altogether.
The guide lists some major spots too, right? Jurong Port, Changi.
Yeah, Jurong Port FTZ, Changi Free Trade Zone, coupled Distra Park. These are large established areas with all the facilities and streamlined customs procedures.
So the infrastructure is definitely there.
No question.
Let's circle back quickly to taxes, specifically GST and duties on imports.
Okay. The Goods and Services Tax, GST. As of 2025, the rate is 9% for goods imported for consumption in Singapore.
And that's calculated on.
The CIF value. That's cost, insurance, and freight. Basically, the total cost to get the goods to Singapore.
Collected by customs, but managed by IRAS, the tax authority.
Correct. Important to factor that 9% into your landed cost calculations.
What about import duties, separate from GST?
Good news here for most people. The vast majority of goods entering Singapore are actually duty-free.
Oh, really?
Yeah. There are only a few specific categories that attract duty.
Which are?
Alcohol, tobacco products, motor vehicles, and petroleum products. Those four.
And the rates vary for those.
Yes, the duty rates differ depending on the specific item within those categories. You'd need to check the exact rate for your product.
But for everything else, no import duty. Just the GST if it's staying in Singapore.
Generally, yes. And if goods are just transiting through or being exported from Singapore, then no GST or duty applies at all.
Makes sense. Facilitates that hub role. Payment method. Any recommendations?
The guide suggests using GRO, that's General Interbank Recurring Order. Basically, an automated bank payment system.
Why?
It tends to speed up customs clearance because the payment is handled smoothly and electronically. Less hassle. They also mention there's a separate guide just on GST registration if you need more detail on that.
Good to know. Okay, almost there. Final section. Financial considerations. What else do businesses need to think about?
First and foremost, get a local business bank account.
Seems obvious, but why is it stressed?
Well, for prompt payments, accessing trade finance products specific to Singapore, keeping funds secure, it just makes everything run smoother. The guide even lists reputable banks like OCBC, DBS, Standard Chartered, UOB, HSBC, Citibank. Plenty of choice.
Right. What about funding, especially for smaller businesses?
There are options. The SME microloan, for instance. Government-backed.
Who's eligible?
Businesses with less than $1 million turnover and fewer than 10 employees. It can offer up to $100,000.
That could be a lifesaver for a startup.
Absolutely. There are also standard non-guaranteed term loans, maybe $50K to $300, paid back over 3-5 years typically.
Okay. And for the bigger players?
There's something called the Global Trader Program, GTP. This offers a significantly reduced corporate tax rate like 5% or 10% instead of the standard 17%.
Wow. For how long?
Usually for 3 to 5 years on income from specific trading activities like physical trading, brokerage, commodity derivatives. It's designed to attract big international trading houses.
Makes Singapore even more attractive for them. Any help with managing risk? International trade can be risky.
Yes, the Trade Credit Insurance Scheme, or TCIS, this insures you against your buyer not paying.
That's huge.
It is. And the government might even subsidize part of the insurance premium, potentially up to 50% of the minimum cost, up to a lifetime cap of $100,000 per firm.
Conditions apply, I assume.
Of course. You need to qualify, use Singapore-registered insurers, but it's a significant potential benefit for managing non-payment risk.
Finally, letters of credit, LCs.
Still very common, especially for larger deals. It's basically a bank guarantee of payment. Reduces risk for both the buyer and the seller.
But the guide mentions some pretty high eligibility criteria.
Yeah, LCs are typically used by larger, more established companies. The guide mentions benchmarks like maybe 200-plus employees, $100 million turnover, ACRA registered, significant local ownership. It reflects the scale usually involved when LCs become necessary.
Okay, so that really covers a lot of ground.
It does, from the big picture advantages down to the operational details.
So wrapping up, setting up import-export in Singapore, it really does seem like a smart move strategically.
You've got the streamlined rules, the low taxes, the amazing port efficiency, strong financial backing, those trade agreements. It's a powerful combination.
It's not just a location. It feels like a genuine strategic advantage for anyone serious about global trade.
I think that's fair to say. It's designed to make trade faster, cheaper, and safer.
Whether you're exporting, importing, or just using it as that crucial transshipment hub we talked about.
It provides the environment and the tools to do it effectively. Singapore's commitment to facilitating trade is really clear.
So if this deep dive has got you thinking, maybe the next step is looking into it more seriously. Perhaps checking out resources like the guide we use from On Demand International.
Definitely. Further research, maybe talking to experts on the ground if you're serious. Those would be logical next steps.
And just a final thought to leave you with. thinking about Singapore's central role, its efficiency, what untapped opportunities might actually exist for your specific niche, your industry within that whole ecosystem?
Or even if Singapore isn't your direct target market right now, how could its model that focus on efficiency, connectivity, smooth processes maybe inspire a fresh look at your own international trade strategies, wherever they are? Food for thought.